Welcome back to Capital Ideas. I'm Nick Morgan, the co-founder of ICANN, Investor Choice Advocates Network, and the co-host of today's episode of Capital Ideas, where we celebrate the thought leaders and innovators attempting to make our capital markets accessible to more people.
And I'm Dara Albright. I am the co-host of Capital Ideas and a very proud board member of ICANN. And today, please join us in welcoming Alexander Platt to the episode. Alex is a law professor at the University of Kansas Law School who recently published a paper titled Rethinking the IPO Bureaucracy. And in it, he calls for very much needed reforms to the SEC's IPO qualification process. So first, Alex, thank you so much for being on today's episode and for writing the paper.
Thanks so much. I'm happy to be here.
So in the paper, you propose abolishing the IPO bureaucracy. And can you discuss a little bit of the flawed process and how it became this, bloated bureaucracy in the first place?
Sure. Yeah. So let's go all the way back to 1933. The basic idea of the Securities Act, which was enacted in that year, was if you're a company and you want to sell shares to the public, you've got to file a disclosure called a registration statement, wait 20 days, and then you can go ahead and sell unless the agency files a formal action to block you from doing so. That's the statute that was enacted in May of that year. 60 days later, on the day it was supposed to take effect, what happens? You get a boatload of registration statements filed, as many as 100. And the guy in charge at the time was a man named Baldwin Bain. He looks at this giant stack of paperwork. He gives it to his staff, pretty small group of staff at the time. They turn out to be eager beavers, and they look at all these registration statements and they find that they're all materially deficient, and they recommend that the agency file formal enforcement actions against all of them.
Wow.
Now, Mr. Bain did not do that. He also didn't pick the 5 or 10 worst offenders to sue and let the others go through. Instead, what he did was direct his staff to write letters to each of these issuers, advising them of the issues they spot, suggesting that they make amendments, and threatening an enforcement action if they did not comply. So that is the system that was created right off the bat, and that's the system we have today. A couple tweaks along the way, but more or less that's what we have today. Filers expect and do receive letters. Usually it's 3 or 4 or 5 letters from the agency. They go back and forth. On average, the process adds about 5 months to the IPO timeline, going back and forth. And this is after the issuer, its investment bankers, its lawyers, and accountants have probably spent several months drafting the thing in the first place. So it really adds quite a long delay to the already cumbersome IPO process.
And did I hear you correctly? Did you say that in the actual 33 Act, it's a mandate that it has to be done within the 20 days?
Yeah, you can go ahead and look at the statute. Still to this day, it says the registration statement takes effect after 20 days. So that is still in there in the law. What's changed is over time, regulations and some statutory amendments have allowed for extensions of that time. And indeed now, when you file your registration statement, there's language you put in there that says it automatically extends the timeline until the SEC has gotten satisfied with your amendments to it. So there's, kind of creative lawyering has been done, but if the statute still says 20 days.
Amazing. And so maybe you could also talk a little bit about some of even the macroeconomic or political consequences that the current IPO qualification process, has.
Sure. Yeah, I think it's fair to surmise that an IPO firm might be dissuaded from pursuing the process just because they know this long 5 months on average with a lot of variation in there, that is going to be tacked on. You might have some firms deciding not even to bother because they don't want it, they don't have the tolerance for that kind of delay or uncertainty. Then there are other firms who start the process and don't finish it. So this is another thing I add in the paper, which is it's been difficult to know exactly what's going on with IPO withdrawal because under the Jobs Act of 2012, issuers are allowed to file confidentially and withdraw confidentially. So since 2012, we haven't really been able to know, well, how many people are starting the process without finishing it. I was able to get from the agency for the first time some data under the Freedom of Information Act about the monthly volume of confidential filers. And I've used that in this paper to do kind of a rough estimation. And it looks like about 2 out of 5 IPO filers withdraw or just fail to complete the process.
Wow.
So if you're worried about declining IPOs or decline of the public markets more generally, I do think that this process, this comment letter process, is a good target for some reform.
Wow.
Just looking at the actual companies that do IPO, which maybe isn't as a precise measure as the data you were found for those who start but don't finish. Wall Street Journal report from a couple of weeks ago, U.S. companies raised just $32 billion in traditional IPOs in 2024, well below the 10-year average of around $49 billion. So, I mean, even if just measuring, and then there are probably other causes for that, but I have to imagine the complexity of the IPO process and comment letter process itself.
There's a lot of interesting ideas that are being floated to boost IPOs again. What I like about this process is, or this reform is that this process doesn't seem to be creating much in terms of benefits. It's adding a lot of costs. And so it seems like a clear area for needed reform. So even if you take the SEC comment process out of the equation, these filings are getting scrutinized by just an amazing array of very sophisticated, well-resourced, and well-incentivized actors. Not only the experts inside the firm, but also their outside advisors, and especially these institutional investors who are the buyers of IPOs. I mean, these are not the investors of 1933. Back then, it was regular people, right? And so it made some sense for the agency to want to stand between the seller and these vulnerable investors. Today, these are the largest institutional investors in the world. I don't know that it makes as much sense anymore for the government staffers to be line checking every aspect of these disclosures. The investors are capable of fending for themselves, I think.
So many thoughts that brings up. One is I can hear the people who wring their hands about changing the process saying, well, wait a minute, won't the end result be registration statements? You know, if we abolish or severely narrow the comment process, aren't we going to end up with registration statements that are just not as good for investors and it won't have the information that investors need? Is there any meat to that kind of a response?
So that was the idea back in the 30s and 40s and 50s, and I think that idea made a lot of sense back then. It just doesn't make sense today anymore. So back then, the IPO firms who were writing these disclosures, they didn't really have a way to know what was required under this new system. Today, there's just mountains of guidance, expertise, there's precedents, there's model disclosures, there's so much information at everybody's fingertips. I just don't think that makes sense anymore. In the early years, another change is, in the early years, we had theoretically the possibility of a lawsuit in the event of a fraudulent statement, but in practice, not really. There were only a handful of suits under the 33 Act under Section 11 in the first 3 decades. Today, of course, that is very different. We have the class action, which didn't exist back then. And we have the institutional plaintiffs bar, who are very, very aggressive and impose a very serious deterrent threat. I think it's like 10 to 20% of IPO firms face a securities class action today. So we no longer have to worry in the same way. We don't need that front end prevention. We have the back end.
Right.
I could go on and on, but here's, I think the biggest change is this. In the early years, IPOs were kind of the only game in town. If you were a firm and you wanted to raise capital, you had to do an IPO. So if the SEC wanted to raise the costs of that, have a comment letter process, add a couple months, firms were stuck. They had to stay in that process nonetheless. Today, that is not our world, right? We have so many alternatives, M&A, SPACs, private placements. And so every time the SEC is raising the cost of an IPO, what are firms doing? They're going elsewhere. And I think that's the situation we're in today.
Yeah.
Great point.
When you talk about different private incentives to ensure that the information needed gets disclosed by the company in the IPO process, another thing that comes immediately in mind is, of course, artificial intelligence, large language models, and the like. Dara and I interviewed a graduate student, also named Alex, by the way, about a year ago, who even then was using ChatGPT and had come up with a tool to analyze registration statements and periodic reports. He was doing it for the purpose of analyzing so-called information bloat, information that was in there but not really helpful to investors. But I have to think that's another tool that, like, obviously wasn't around 90 years ago, and is now heavily used. You could throw 2 registration statements in and have ChatGPT or some other large language model just bump out a lot of analysis, which even maybe the SEC staff should start thinking about using large language models. God forbid.
Yeah, I'm sure there are firms out there doing this already. I'm sure lawyers and accountants and banks are doing this. But it's worth just noting how modest this proposal really is. It sounds like a big change, get rid of the comment process, but I just want to reiterate, nothing else needs to change. We still have mandatory disclosure. I think we still have SEC putting out prospective guidance as far as what should be in these things. The only difference would be we're not doing individuated line by line 5-month-long review of every registration statement. I think that we don't need that as much anymore. And I think if we're looking for places to cut costs in agencies and to potentially cut costs in IPO process as well, I think this is a good place to look.
And I'll just add too, just to quantify it, because I'm actually working on IPO numbers for another project. And the fact remains is that the IPO exits just can't keep pace with all the venture capital investments that are going into these companies. So then they're stuck, that this is raising liquidity risks. And it's just really having dire macroeconomic implications. Because if you look at even just 2024, for an example, venture capital firms invested in over 15,000 different venture deals. They only got total exits of about 1,260 deals. But out of those, only 37 were traditional IPOs. That's significant. And when you look at the size, I mean, the venture capital market was like 200 billion last year, and the IPO market was 30 something billion. So that's not keeping pace.
Right. And so there's lots of stuff on the table now. I think there's a whole category of reforms out there to try to expand access to private markets for retail investors. That's out there, and it looks like there's some momentum behind it. What I'm talking about is let's try to bring some more firms into the familiar, time-tested system of public markets where you have not only disclosure and transparency, you have what's more important, which is liquidity, active trading. That's really where investors get protection, right? It's not from reading a disclosure. It's from having a lot of smart people out there trading it all day long You could put it in your diversified portfolio. That's how regular investors get protected. But that only works if the companies are going public.
Right.
And if they're all just staying private, or if they are, joining, being, bought by the same three ginormous companies, it's not the same exposure to diverse, firms and diverse business areas. So I do think the case for encouraging more firms to go public, and it's a bipartisan issue, I think. So I think this is worth a look.
Yeah.
I think you're right. Well, if we did nothing more than return to the initial presumption that you described from the 33 Act, that would be phenomenal. In other words, the presumption being it will go effective unless the SEC takes affirmative action. That would be quite a change.
Yeah, and I think the philosophy behind that is one I think that just makes a lot of common sense. SEC's rule, you make the rules, you enforce violations. You don't get involved in assessing individual investment opportunities. There are market actors who are very good at that, and today they are more than capable of doing that. And if there's a violation, fine, sue them, go after them for a fraud or misstatement. There's a private bar that can do that as well. But we don't need, I don't think, the same thing we did back in those early decades of an agency to do this kind of individuated review.
Well, maybe we'll leave it there. Professor Platt, thank you so much for joining us. We'll include a link to your paper when the recording comes out. Dara, as always, thank you. For anyone who wants more information on ICANN, go to icanlaw.org, and we'll see you on the next Capital Ideas. Thank you.